Bond interest rates right here, ladies and gentlemen. What I want to talk about. We're talking about tech stocks dropped today as bond yields started to spike. So in this episode, ladies and gentlemen, we're going to take a look at exactly what happened with the bond interest rates and tech stocks dropping and the bond yields that responded. But ladies and gentlemen, if you haven't done so already, please go ahead and make sure.
Hit the subscribe button, hit the bell icon, hit that like, comment, and share button.
Once again, ladies and gentlemen, boys and girls, and children of all ages, you are now tuned into the Investor Show. As always, this is your gracious host coming with a late night episode about the tech stocks dropping and bond yields going up. And if you haven't done so already, ladies and gentlemen, make sure you hit that subscribe, and comment button. Maybe it's a little late at night. And I'm just getting back in my zone a little bit. I was out on travel for a little while. Got some good content coming to you guys and girls. But I've been out of the pocket for a little minute. I'm kind of getting back in my zone a little bit, bringing that good content to you guys and girls that I've been doing for years, that I'm known for. And I just want to sit down and have a late night conversation with you. So if you are up late at night, please check in and tell me where you're from. Drop a comment. All right. So, ladies and gentlemen, the first thing I want to get into is the Fed tapering. This has been kind of known right now. A lot of people have been talking about the Fed tapering. And the Fed tapering essentially is one of the stimulus programs. This is a monetary policy that was done by the Fed that's been going on for a long time. But they really pushed this back in 2020 when the pandemic started to strike. This was one of their ways to stimulate the economy. And their way to stimulate the economy was to, hey, let's essentially buy assets, pretty much pump money into bonds, pump money into the stock market, things like that, to increase the liquidity. Increase the liquidity is a fancy way of putting out more money to be bought and sold. So the federal government is saying that, hey, we want to start tapering away, meaning that, hey, we want to slow down on buying some of these assets, buying some of these bonds, pumping money into the stock market. So when you see that, what does that mean for people, investors across the world like you and I? So the next thing is the federal government also sees interest rates rising next year as soon as 2022. You know, as I know, if you've been following this channel enough and been following the markets enough, you notice the interest rates has been at an all-time low. The Federal Reserve put interest rates at an all-time low back in 2020 when the pandemic happened. When you lower interest rates, this makes money cheap to borrow, and it makes money cheaper to borrow, and it pushes up the stock market, right? It's a way to stimulate the economy. Now that we're at an all-time low on interest rates, the federal government hasn't touched interest rates, mainly because of the pandemic. Now we're seeing the inflation come along, and the big thing is the job market. The job market is the reason why the government has not raised interest rates back up. Now they're looking at interest rates to be risen back up back in 2022, which they think potentially could slow down the market, right? Now, the next thing is, as you see bond yields start to go up, you're looking at the cynical sector starting to rise. The cynical sector starting to rise. You look at the cynical sector on the S&P 500 has beaten the broader index. So cynical sector is things like airline tickets, luxury cars, retail, things like that. These are things that do well when the economy is doing well. So first off, for the government to say, hey, we're going to slow down on bond buying, that means they think the economy is doing very well. For the government to say we're going to raise interest rates, that means they think the economy is doing well or going into a good place. And when you see the economy do well, things that do well are cynical things, consumer discretionary cynical items. These are things that's like, hey, you know what? Maybe I will fly more if I'm doing better in my life. You know, I may go on more vacations. I may buy a better car. These are things that do better in the economy. So you're seeing the cynical sector point to a bull market. You're seeing the Federal Reserve point to a bull market because they're talking about tapering and they're talking about interest rates being hiked up next year. So when you see these top two things going on, these are the things that you see in the market itself or like ladies and gentlemen, I already told you guys and girls that I think that we're in the midst of a bull market. Now, mind you, that we have things going overseas in China. That is correct. Things are going overseas in China. But if you know me directly, you know that I'm not crazy about international as much, because you're investing into right here in America. We have more of a democracy versus overseas in China. You have more of a iron fist. What's the word I'm looking for here? I can't say it. I don't know why it's not coming to me. Dictatorship. Okay. So when you have a dictatorship, that means the government controls all aspects of the economy. This is why you've seen China come out and say cryptocurrency, they can just ban it like it's nothing. You're sitting to do all type of things that you don't see here in America. So when you invest overseas, you inherit more problems. With you have to worry about bigger government influence. You have to worry about foreign policies. Anything can happen overseas. Things a little bit more volatile. Not saying that there are not any opportunities there. There are a little bit more volatile. You take on a little bit more risk when you go overseas, but you also have greater reward. And for me to go overseas and invest in something, they better be very good, because it's probably doing something that I can't do at home. That's the only way I would go outside the house to grab something, is if I can't do it at the house or I don't feel like doing it at home. And that's the same way I look at investing. Why would I run overseas to look at a car company if I have the same exact car company here in America that I can know, see, and touch, and understand its accounting, understand its market a little bit better? That's just my personal take, right? So you're seeing across the market itself, you're seeing tech stocks from these bond yields started to go up. You're seeing tech stocks start to take a hit. And when I look at this, I just look at these are buying opportunities. I don't see anything going crazy with tech. Tech stocks are growth stocks, and tech stocks are growth stocks, and you also have cynical stocks that are doing very well. But I don't look at this as some pseudo Jedi mind trick of, hey, what's going on with the economy? Tech stocks are a bad thing now. No, they're just reacting differently to the rise of bond yields. People are now looking for more value. As bond yields rise, when bond yields start to rise, they're looked at as the safest investments. And when they're looked at as the safest investments, they become more attractive than a lot of equities. So a lot of people, depending on their investing style, depending on their risk tolerance, they may be seeking more towards bond yields than they are looking towards equities. But right now, with the rising rates of inflation, I think equities are a good spot to be in. And I think that we're going to see a housing market cool off starting next year. I don't see a dump, but I can see a housing market cool off within the next year. And these are the way I'm looking at it. That's kind of what's been going on today. You're seeing tech stocks take a dip. You're seeing China stocks still on sale or discount. A lot of them on sales or discount. And nothing that I'm going to go crazy and jump into China like I'm crazy. That's not what I'm going to look at. But also, we're seeing bond yields rise, and what does that mean? How did these yields start to happen? And guess what? With the federal government doing a taper, with interest rates starting to hike, and you're seeing bond yields rise, these are all bullish indicators, in my personal opinion. All the big wigs are telling you that, hey, we think the economy is doing better. Yes, we have inflation. Yes, we have a rise in prices. Yes, we have a bottleneck on supply. You've seen a lot of things. You go to the store, like the other day I was in Lowe's and Home Depot, and I mean, shelves are empty. I can't even find a bolt that I'm looking for. I got to go search around 3-4 stores and get it offline, because we have these supply bottlenecks that are going on. And also we have a shortage in the workforce as well. So when you're looking at a shortage in the workforce, you're looking at a shortage in manufacturing, you're looking at a shortage in supply, meaning that you're having demand coming in. People are coming into the store to buy goods that the store can't meet the supply, which are raising your prices. But once we get this supply thing fixed, or get back to normal, or figure it out like we always do, we're going to see great numbers going forward. So that's my quick commentary on today's market. A little bit out of pocket, getting back into it, getting back into my groove, bringing out that great content that I've been known to do for years. And ladies and gentlemen, I thank y'all for tuning in on this late night episode. If you haven't done so already, go ahead and make sure you hit that like, subscribe, and comment and share button. I'm going to be bringing y'all some, I'm going to do a Turo. Y'all heard of Turo? I'm going to be giving y'all some content on a little Turo. I used Turo for the first time on my recent travel, and it wasn't bad. I'm going to do a review on that, and I'm going to give y'all some more content, longer content that you guys or girls seem to be more attracted to, that you like, longer content of me talking about daily market and news and things like that, investing. But anyway, ladies and gentlemen, thank y'all for rocking with me. Check out that my book series, Wesley Learns, and the make sure you catch the get your Investor Show mug as well. All right. Get your Investor Show mug. It's the only way to read financial reports. And get your Wesley Learns book series, Wesley Learns to Invest, Wesley Learns about credit, and Wesley Learns about insurance, available everywhere. Once again, thank you guys and girls for your support. And to the next video, podcast, cartoon, or whatever else crazy you see me do around the globe. My name is Prince Dykes. I'm the Prince of Investing. Peace, be safe. I'm out, and thank you.